think this is a proper, full-blown dollar depreciation cycle. And this is due to a large number of factors. First, there is the fundamental factor that the dollar actually...
The ground beneath America's economy is shifting, and it's not the kind of thing you'll catch on the evening news or trending online. It's quieter, colder, and hits harder than any headline. The US dollar, the muscle behind America's global swagger, is stumbling. In just 6 months, it's lost 10.8% of its value on the world stage, the worst start to a year in over half a century. That's not just a number on a screen. It's a slow bleed that's reaching into the lives of everyday folks. Retirees in Ohio, shop owners in Georgia, teachers in Michigan, they're feeling the squeeze, even if they don't know why. While the White House churns out promises of strength and victory, something's going wrong. This isn't about stock tickers or Wall Street jargon. It's about what happens when the world starts losing faith in the dollar and in America. Let's start with the big player no one's talking about, China. For years, Beijing was a major buyer of US Treasury bonds, helping fund everything from highways to hospitals. But since 2012, they've been quietly stepping back, unloading $600 billion worth 44% of their holdings. In April 2025 alone, they sold another $82 billion. No press conferences, no fiery speeches, just a subtle line in a central bank report. It's like a guest slipping out of a dinner party without a word. Washington's too caught up in its own noise to notice. But this isn't just about bonds. It's about trust, the kind that's been holding the global economy together for decades. And right now, that trust is fraying, one spreadsheet at a time. This didn't happen in a vacuum. The spark came when the 47th president, calling himself a master dealmaker, decided to hit China with a sledgehammer. In April 2025, he signed off on a 145% tariff on Chinese electronics and auto parts, the biggest trade wall since 2008. The US trade representatives spun it as a show of strength, but it landed like a misfired shot. Wall Street groaned, and Beijing didn't bother shouting back. They just opened their trillion-dollar ledger and started slashing US bond purchases. Why keep financing a country that's taxing your goods into the ground? It's not a tantrum, it's a calculated move. While the White House bragged about winning, China was rewriting the rules, and the floor under America's economy started to creak. Those Treasury bonds aren't just financial lingo. They're the scaffolding of America's budget. The government spends more than it collects every year, and bonds cover the gap. They pay for Social Security checks, veterans benefits, Medicare visits, even the asphalt on your local highway. The Congressional Budget Office says over 25% of federal spending in 2025 will come from borrowing, mostly through treasuries. But what happens when a heavyweight like China stops buying? The options aren't pretty. Interest rates could climb to lure new buyers, making debt costlier, or the Federal Reserve could print more dollars, sparking inflation that hits your grocery bill like a freight train. One economist called it passive sabotage, and it's not hard to see why. While the president rallies crowds in Wisconsin, promising prosperity, the bond market's telling a different story. China's not just walking away, they're pivoting hard. Since early 2023, the People's Bank of China has been stacking gold, buying about 80 tons a month. By mid-2025, their reserves topped 2,300 tons, one of the largest central bank stashes in the world. Some analysts at UBS and JP Morgan think the real number's even higher, tucked away in offshore accounts. Why gold? Because it's a safe bet. Gold doesn't care about sanctions, tariffs, or late-night tweets. It's immune to politics. When the US started using the dollar as a weapon, slapping tariffs on allies, threatening rivals, China saw the writing on the wall. Why tie your wealth to a currency controlled by someone who treats global finance like a game show? Gold is Beijing's hedge, a quiet signal they're done playing by Washington's rules. This isn't just about big banks or far-off markets. It's personal. Take Michael Simmons, a Navy veteran in Ohio. He got a letter from his pension fund saying they're reassessing their Treasury holdings. To him, it's not a technicality. It's a threat to the retirement he earned, and he's not alone. Over 60% of public pension funds are heavily invested in Treasuries. When foreign buyers like China pull back, bond values drop, and retirees can lose 10 to 15% of their portfolio value overnight. It's like building a life of savings, only to watch someone pull the rug out. While the White House talks tough, it's not the guy at the podium who pays the price. It's folks like Michael, wondering how their future dollar got so shaky, small businesses are getting hit just as hard. From Arizona to Georgia, mom and pop shops depend on credit lines tied to Treasury yields. When bond markets wobble, banks get cautious, hiking rates or cutting loans. The National Federation of Independent Business reported in June 2025 that credit access for small firms hit a 5-year low. For a Michigan auto shop or a Georgia bakery, that means layoffs, missed payroll, or shuttered doors. The U.S. debt clock just passed 37 trillion, with another 1 trillion projected this quarter. If buyers keep stepping back, the system starts to crack. Social Security checks get delayed, VA clinics run short, roads go unpatched. This isn't abstract economics, it's the stuff that keeps America running. Then there's the money leaving town. In the last week of June 2025, $9 billion bolted from U.S. stock markets. It didn't vanish, it moved. Japan, once laughed off as stagnant, grabbed $4.5 billion. Europe, still nursing its own wounds, took $3 billion. This wasn't a panic sell-off. It was a cold, hard calculation. Investors aren't running from danger, they're running from chaos. And that chaos has a source: unpredictable tariffs, erratic policy tweets, a leadership style that feels more like improvisation than strategy. The ultra-wealthy are hedging their bets, snapping up second passports and parking cash in Zurich or Tokyo. Henley and Partners reported a 1,200% jump in U.S. citizens seeking investment-based citizenship since 2020. America used to be where money settled down. Now it's where money stops by, then catches the next plane out. The world's starting to pull away from the dollar's orbit, and it's not just investors. In July 2025, Bank of America began scaling back its dollar clearing operations in Europe, a sign that even U.S. banks see the tide turning. BlackRock, the world's largest asset manager, boosted its bets on Japan and the EU, calling it a permanent rebalancing. This isn't a slap in the face, it's a recalibration. The global system that once revolved around Wall Street is looking for new anchors. The IMF estimates that a long-term shift away from the dollar could cost the U.S. $1.2 trillion in influence and capital flows by 2030. The image of America as the world's economic rock is getting blurry, and the guy behind the Oval Office desk isn't helping. For a century, America built its reputation as the world's financial anchor. One presidency is testing how much of that credibility still holds. The dollar's still the king of currencies, but kings can fall when allies stop listening and investors start walking. China's $82 billion bond sell-off in April wasn't a headline, it was a whisper, but whispers carry when they're backed by trillions. People are starting to ask, why is my pension shrinking? Why is my school cutting programs? Why is the VA falling behind? The answers point to a trust deficit, fueled by tariffs, bravado, and policies that spook the very buyers who keep the lights on. While the president promises to make America strong again, strength isn't just about flags and speeches. It's about confidence. Confidence that your bonds will sell, your currency will hold, your promises will stick. Lose that, and no rally can fix it. Empires don't collapse overnight. They erode. One broken alliance, one spooked investor, one reckless move at a time. The dollar's still the backbone of global finance, but backbones break under too much strain. Gold prices are climbing, with Bloomberg predicting $2,600 an ounce by year's end if demand holds. China's stacking it like a fortress, while the US keeps printing dollars to cover deficits. One side's betting on stability, the other's banking on slogans. The world's watching, and it's not just about markets. It's about what America stands for. The promise of stability that once drew capital from every corner is starting to feel like a gamble. The guy at the podium keeps talking about winning, but the scoreboard's telling a different story. Trust isn't built with tariffs or applause. It's earned with consistency, reliability, something the world's starting to doubt. The dollar's still got weight, but confidence is slipping. So here's the question we all need to wrestle with. Can the dollar hold its throne for another decade? Or are we watching the start of a new world order? One where America's word isn't the last one anymore.